My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people, my friends, I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Look, you can't blame anyone for missing this spectacular rally that started 10 days ago.
That was easy.
They know nothing! It took us all by surprise. Almost everybody. But after a day like today, when the Dow gained 555 points, S&P jumped 1.61%, and the Nasdaq scorched 2.34% higher, you know what? It's worth thinking back to what happened in the Monday meltdown 2 weeks ago, just to get a little much-needed perspective. Now, I don't want to just rehash the turn. You don't need this weatherman to know which way the wind blows. Instead, here's what I want to do. I want to talk to you about the obstacles to catching a tradable bottom, because they are incredibly powerful. At the lows 2 weeks ago, everybody wanted to sell. Not buy. Even though, in retrospect, it was a tremendous opportunity to purchase some high-quality stocks at bargain basement prices. Now, it all starts with an initial decline that took people by surprise, and then it reverberated through the stock market. On that Monday, 2 weeks ago, we saw the Dow fall 2.6%, S&P lose 3%, and the Nasdaq nosedive 3.43%. It was a horrible, dispiriting session. Why did it happen? All right, the explanation was very mysterious. We were told that the yen carry trade broke up, and apparently that's a massive and lasting problem, right? Sometimes, just to see how bad it is, it pays to look at the next day's summary in the Wall Street Journal, because it's the most authoritative real-time account of all the pain and fear people experience. Under the headline, and I quote, "Unraveling Trade's Fuel Market Rout," we read, quote, "The unwinding of some of Wall Street's most popular trades intensified Monday, sending Japanese stocks to their worst day since the 1987 market crash and walloping U.S. technology shares." For the vast majority of home gamers, and a goodly number of professionals, this excuse sounded ominous. Popular trade, must have been hundreds of money managers involved. A mention of the devastating 87 crash, where Japan's meltdown heralded our own horrific collapse. When they say tech was the focus, doesn't that mean the Magnificent Seven are done again? Somehow, they must relate to this mysterious yen carry thing that helped send the Nikkei down an astounding 12% that day. Many thought there'd be some inevitable contagion. On top of that, we discovered that the smartest investor in the world, Warren Buffett, was selling tens of billions of dollars worth of stocks, including a lot of Bank of America, a long-time holding, and Apple, a stock he said he wanted to hold on to as recently as last month. So we have the best of the best investors lightening up while the averages collapse. It made you feel like an idiot for buying stocks or even owning them. If Buffett's blowing out of Bank of America, didn't you have to sell the banks, even though Bank of America had the best quarter of the majors, right? If he's selling Apple, I mean, he must know something's wrong, right? I mean, he knows everything. So why don't we just shoot the stock first and ask questions later? It's only natural, right? The yen carry trade implosion, Buffett blowout, then you know what that is? A 1-2 punch. But if we parse these negatives, we discover something that is so different that it's almost embarrassing. In the end, these turned out to be incredibly flimsy reasons to sell. Alibis for dumping stocks sound very convincing when the averages are getting crushed, don't they? But you need to put them to the test, or else they'll lead you in the wrong direction. They often do. For example, the carry trade. All right, now that's just probably when everybody goes, carry trade. That's genuine Wall Street gibberish for borrowing money. The fund managers who were borrowing money were borrowing it in yen because Japan has some of the lowest interest rates in the world. But when the Bank of Japan suddenly raised rates a couple of times, the yen spiked and the cost of borrowing money in Japan soared. Just think of it like this. They have an adjustable rate mortgage. You take it down to 3%. Suddenly it goes higher like that. Maybe to the point where you can't afford the house anymore. In short, the institutions that were borrowing yen, and they weren't that many, it wasn't hundreds, the ones that were borrowing yen suddenly had to raise money immediately, which is why they sold practically every stock under the sun, including our great stocks. Yes, it was a popular trade, which meant there were a lot of forced sellers. That was a huge part of why the market got crushed. Too many complacent portfolio managers borrowed too much money, thought they were really smart. They turned out to be dumb. They're hiding right now. We won't know who they are, or I would put every single one of them on the wall of shame right behind me. Pretty simple. More importantly, it was never a long-lasting problem. It was a one-off, even though the papers made it sound like it was going to be with us forever. The other pillar of pain, Warren Buffett selling Bank of America and Apple. All right, Buffett's the best there is, so he's the best there is. So people looking at his moves and end up extrapolating to the point of absurdity. And that's why they dumped the banks. It's why they dumped Apple. We heard it was based on Apple's supposedly weaker Chinese sales, yet CEO Tim Cook told me just the week before that the sales were surprisingly strong, and I detailed why that was. For the rest of the week, until we got a positive jobless claims number Thursday morning, we labored under the delusion that our economy was headed for a recession, potentially a worldwide recession, all because of Japan. And the safest thing to do was to sell. It didn't matter that Japan only bounced back 10% the next day. What mattered was the smart money was getting out of the whole asset class, and we felt like dopes hanging on. In reality, it was the dumb money that was getting out, in part because Warren Buffett or one of his assistants made us nervous. Of course, we knew nothing about why he sold. Maybe he was just ringing the register. Big gains. Nobody cared. It just made everything more fraught, more fearful. And, of course, just so we know, Japan, I mean, who knows? There was absolutely no contagion. Now, let's take a step back. There are two parts to every sell-off. The averages get crushed when you have a wave of sellers like these knuckleheads with the yen money. And then the other part of it, though, is a lack of real buyers. We knew who the sellers were, these troubled money managers, and we thought we knew their motivations. But if you wanted to do something, if you wanted to buy, you ran into a real problem. It is earnings season, and it's a big one. And while you might hear that it's going well, we actually lack a series of big beat and raise quarters. We got a lot of such surprises where management left their full-year forecast unchanged, which is basically an implicit guide down. So very few stocks seem like enticing buys at that moment. Even though the selling turned out to be based on pretty much nothing, hardly anything looked like it was pounceable, so to speak, like you wanted to buy it on the dip. When I scanned the earnings report from this season, few companies actually beat and raised. Let me tick them down for impact, write them down. First, we had two tech companies, that's right, only two, that gave you fantastic sales, earnings, and forecasts. That's the magic shortcut that makes people feel comfortable buying even into a tsunami of selling. And those two were ServiceNow and Mark Zuckerberg's Meta Platforms. They both blew away the numbers and gave you super forecasts. Interestingly enough, both companies are using AI powered by the latest and greatest of NVIDIA's chips. Meta, in particular, told a great story about how it can use AI to design and ad programs that are fantastic with a great return on investment for advertisers. That's an unbeatable combo. One drug company, Eli Lilly, gave you the best beat and raised quarter of the entire season, and that's thanks to the GLP-1 weight loss drug. Coca-Cola delivered a nice set of numbers, conservative beat, worth owning. Aerospace shine, GE Aerospace, followed by RTX, and then Howmet. We call that How I Met My Mother, but it happens to be a company that designs screws, fasteners, they call them, for planes. Two Simple Industrials made the cut. Parker Hannifin, it was very nice. And Eaton trounced the numbers by doing prosaic things, the kind of things industrials do. And Uber delivered an incredible quarter, showing that people are still going places and doing things. That's it, though. Oh, and sure, we can throw in Walmart now, but it's really too late. The buying opportunity is probably over. The bottom line on this incredibly important story that occurred over the last 2 weeks, there will be other buying opportunities in the future, other crazy sell-offs. But let's remember that very often these market meltdowns are driven by nothing. What happened 2 weeks ago was pure market mechanics, nothing to do with the fundamentals. So keep that possibility in mind the next time the averages get clubbed. It might be the opportunity you've been waiting for to do some buying. Why don't we start the calls with Peter in Florida? Please, Peter.
Hi, Jim. Peter in Florida. One question, if I may.
Sure.
AT&T, let it go or should I stay?
Let it go. There's a lot of better opportunities, including, by the way, T-Mobile, which is really a horse. Why don't we go to Greg in Tennessee while we're at it? Greg.
Good day, Mr. Cramer. It's a pleasure to talk to you.
Right back at you.
About 7 months ago, I bought a stock in what I thought was solid and consistently profitable company, and it's been terrible. It feels like I've got another Intel on my hands, and I'm down about 25%. Do you think it's time to sell to cut my losses or hang on to Nucor?
Oh, no, don't sell Nucor. Okay, look, Nucor. Nucor is in the end, a cyclical company. We sometimes want these big steel companies to be something other than what they can be. In the end, they are still tied into the earnings cycle. They're still tied into any downturn. But when the Fed starts cutting rates, the first stock people are going to reach for, including me for my Chapel Trust, will be Nucor. So please do not sell the stock. All right, look, you have to remember that very often the market meltdowns we get are caused by nothing. What happened 2 weeks ago was purely market mechanics. All the stories were wrong. So keep that in mind the next time we get a sell-off. It's often based on nothing. Oh, man, buddy, tonight, 2 years since the implementation of the Inflation Reduction Act. How is Jacobs Engineering faring? I'm going to talk to the CEO after earnings. Then Walmart beat on top and the bottom line and hiked its full-year guidance, as I just mentioned, citing healthy consumers. So could it be a sign of good things to come? I'm getting into the retail details. Plus, I'm eyeing an under-the-radar housing play that you told me about and telling you, maybe it'll be worth buying, maybe not. I'm turning into homework. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.